How can someone sell something that he doesn't hold? Well, this is market and it never fails to surprise you. Hello, I'm Abhishek Sood from Brainvibe. Today we'll be talking on short selling. Short selling is an investment or trading strategy that speculates on the downside of a stock or other securities prices. It is an advanced strategy that should be undertaken by only experienced traders and investors. Traders use short selling as speculation. Meanwhile, the investors or portfolio managers use short selling as a hedge against downside risk of a long position in the same security or related one. These were all bookish terms. Let's understand this with an example. Let's suppose Ishika wanted to buy a pizza for 100 bucks. So she went to the market for the same and met Manu in the market. She met Manu and told him that I want to buy a pizza for 100 bucks. Here Manu didn't have any pizza but thought I could get the same pizza for some lower amount like 80 rupees and can get the difference in both the amounts as his profit. So while thinking this, he accepted the order and promised Ishika to provide the pizza at 100 rupees. Same is the case with short selling. You can sell something you don't have, but you need to promise that you will provide the securities on time that you have promised. Now, let's come back to the story. Manu accepted a deal, but there is no surety that Manu will get the pizza for 80 rupees or something below 100. So let's understand the three cases here. The first case, Manu got pizza for a price less than 100. That is, example 80 rupees. Now here 20 rupees will be Manu's profit. The second case is Manu got the pizza for a price more than 100, might be 120. In this case, Manu's loss will be 20 rupees. Now there comes a third case. What if Manu forgets or was unable to provide the pizza to Ishika at any price? Or what if the seller was not able to provide the securities to the person he has sold? In that case, I don't know what will happen in pizza, but in stock market, exchange provides auction facility for this. Now, what is auction here? We don't need to understand the concept of auction more deeply, but we need to understand the requirement of the auction. Here the requirement of the auction is to settle the dispute between Manu and Ishika, as Manu was unable to fulfill the promise of Ishika. So here in this auction, the exchange will call the shareholders and ask them to sell their shares to exchange. Now they can give at any rate. The lowest rate will be respected. The exchange will get the shares from these shareholders and give the shares to Ishika. And the difference between the price that exchange got and the price at which the Manu and Ishika got their deal, this price will be charged as penalty on Manu. Is there only three possibilities? Well, in case of pizza, there is always a limit of a restaurant, like it can be 100, 1000 or even 10,000. But how can we expect that there is no limit in the stock market? There is also a limit in the stock market, and that limit is called upper limit, that is upper circuit, and lower limit is called lower circuit. When the stock hits upper circuit, there is no buy order, all the buy orders are cancelled by the exchange. Meanwhile, when the stock hits lower circuit, all the sell orders are cancelled by the exchange. What if there is no pizza? Then how will Manu fulfill his promise? In the same way, there is no stock in the exchange, then how will seller provide the shares to the buyer? Well, this question is still answered, but the concept is same, auction. But what if there is no seller in the auction? In that case, the exchange will give Ishika 20% returns calculated from the day's closing, and the difference between the price that Ishika will get and the price that Ishika and Manu confirmed the order, the difference between this price will be levied as a penalty on Manu. Sometimes these penalty can rise up to 50% if share is in good momentum and hitting upper circuits. So this was Manu's fault, or the system is not designed properly. We can't say anything, but we can protect ourselves by using a stop loss in the short positions. I don't know if you use stop loss more regularly or not, but you should definitely use stop loss in your short positions or in short selling. In fact, you can use near your upper circuit so you cannot be a trap in the trade like Manu. In Indian stock market, we can short in cash market only from 9:15 a.m. to 3:15 p.m. But in futures and option market, we can short for a time period from 1 day to a time period of 3 months. That is the duration of the contract of future and options. There are 3 ways to short, that is selling direct futures of some securities, or selling call options, or buying put options. So this was all about short selling. If you have learned something, do like this video and share this with your friends. Don't forget to subscribe to Brainvibe and press the bell icon. Also, don't forget, opening Demat account is not a tedious job. We, the team of Brainvibe, is always there to help you. The links are there in description. Also try our financial tracking app from the link provided below in description. Thank you for watching this video.